Gold just had one of its ugliest weeks in months, and almost everyone watching it is drawing exactly the wrong conclusion. The price is falling, the charts look broken, the headlines have turned cold, and the crowd that was cheering this rally just a few weeks ago is suddenly very quiet. To most people, it looks like the top is in, like the story is over, like they missed it, or worse, like they got caught. But here is what almost nobody is telling you. The weeks that look the worst on the surface are very often the weeks that matter the most underneath. Because what is happening to gold right now is not the end of something. It may be the setup for something far bigger. Stay with me, because by the end of this video, you are going to see this sell-off completely differently than the headlines want you to. My name is May, and this is What Changes, the channel where we track the real shifts in the global financial system before the headlines catch up. So let's start with what is actually happening. Gold is trading around $4,200 an ounce, on track for its second straight weekly decline, and it has now fallen close to 12% in just 9 trading days, sliding from its late May high near $4,627. In a market that usually grinds slowly, that is a sharp, attention-grabbing move. But notice something. The drop is not coming from anything wrong with gold itself. Nothing changed about what gold is. What changed is the noise around it, interest rates, and the dollar. May inflation came in hot at 4.2% year over year, the fastest pace since 2023. Rate hike fears came roaring back, the dollar firmed, and that is what knocked the price down. Here is the mechanism, simply. When the market starts believing the Federal Reserve will keep rates higher for longer, gold comes under immediate pressure. Higher rates raise the opportunity cost of holding an asset that pays no yield. And a stronger dollar makes gold more expensive for buyers everywhere else in the world, which softens demand in the short term. That is the entire story behind this week. Rate fears came back. The dollar firmed up, yields pushed higher, and gold pulled back. Nothing mysterious, nothing structural, just positioning and sentiment doing what they always do. And here is the part that gets ignored. Step back from the daily chart and look at the bigger picture. On a longer timeline, gold is still up around 28% from where it was a year ago. The trend has not reversed. The foundation has not cracked. What we are watching is not a collapse driven by fundamentals falling apart. It is a correction driven by liquidity, leverage, and short-term emotion. Precious metals have done this for as long as they have traded. They sell off in exactly these moments, when financial conditions tighten, when real yields rise, when the dollar gets strong and liquidity gets pulled out of the system. Gold struggles in the short term under that pressure. But here is the twist that the crowd misses every single time. Those exact conditions are usually what create the stress that eventually drives gold higher. Let me connect the dots for you. When central banks raise rates aggressively to fight inflation, they are also quietly tightening the screws on everything else, on governments, on debt markets, on the entire borrowing system. Higher rates mean higher borrowing costs. And in a world buried under record levels of debt, that pressure builds fast. And we are not talking about small numbers. Global debt is at historic highs. Governments are running enormous deficits. And the cost of simply servicing that debt climbs higher every month that rates stay elevated. So yes, in the short term, high rates strengthen the dollar and weigh on gold. But at the same time, they are creating deeper structural problems. Problems that do not go away. Problems that pile up, and eventually, those problems force a response. That response almost always looks the same in the end. Rate cuts, liquidity injections, support for the system in one form or another. And every time the system gets that kind of rescue, hard assets like gold tend to move, not gently, but powerfully. So what you are really watching right now is a tug of war between two forces. On one side, short-term tightening, rising yields, a strong dollar, all pushing gold down. On the other side, structural debt, sticky inflation, and a fragile system, all quietly pushing it up. Right now, the short-term side is winning. But winning a week is not the same as winning the war, because the bigger backdrop has not changed at all. Inflation is still in the system, even when the monthly numbers bounce around. The cost of living, housing, food, energy, services, is still elevated, and the world is not getting calmer. Geopolitical tension, trade fragmentation, and strategic competition are all making the global picture more uncertain, not less. And there is one signal in all of this that you should not ignore. Central banks are still buying gold, aggressively. In the first quarter of this year alone, they bought a net 244 tons, more than the previous quarter, more than the 5 year average, the fastest quarterly pace in over a year, and a record $37 billion spent in a single quarter. And they are not slowing down. China's central bank just logged its 19th straight month of buying, adding another 10 tons. Think about what that means. While short-term traders panic and sell into this dip, the largest, most informed players on the planet are quietly accumulating, and those two groups are not playing the same game. Central banks are not trying to scalp a quick trade. They are buying gold as protection against currency risk, against instability, against the slow erosion of trust in the system itself. So when you see retail sentiment turning fearful while central banks keep buying, you have to ask the real question: is this weakness? Or is this a window? Now here is where it gets serious. If the Fed keeps rates high to hold inflation down, the strain on the system keeps building. More pressure on banks, more stress in credit, more pain for governments managing their debt. But if inflation stays sticky, the Fed cannot just cut rates without risking another spike in prices. And if it holds rates too high for too long, it risks breaking something. Analysts have a name for this. They call it a policy trap. And in a policy trap, there are no clean exits. Cut too early. Inflation comes roaring back. Stay too tight. Something in the financial system snaps. And in both of those outcomes, gold quietly becomes more important, not less. Because gold is not anyone's liability. It is not a promise. It is not a number on a screen that depends on a politician or a central banker keeping their word. It sits outside the system, and when confidence in that system wobbles, even a little, demand for the things that live outside it goes up. That is exactly why these sell-offs are so misleading. They create the feeling that the trend is dead, that the move is over, that you missed your chance. But more often than not, they are just part of the process. Markets do not move in straight lines. They move in cycles. They build, they correct, they consolidate, and then they move again. And the strongest moves usually come right after the sharpest pullbacks, when everyone else has already given up. So here is where we actually stand. Gold is under pressure. The dollar is strong. Yields are up. Sentiment has turned cautious. That is the surface. But underneath, the bigger forces are still fully in play. Inflation is not beaten. Debt is still extreme. Central banks are still buying. And the system is still fragile. That combination creates a very specific kind of setup, a setup where short-term weakness sits right on top of long-term strength, a setup where fear is doing what fear always does, creating opportunity for the people calm enough to see it. Now, I want to be straight with you. This does not mean gold turns around tomorrow. These phases can drag on longer than anyone expects. Volatility can stay high. The price can go lower before it goes higher. But for long-term thinkers, this is usually where positioning quietly begins. Not when everything feels safe, not when the headlines are loud and bullish, but right now, when uncertainty is high and the crowd is nervous, because that is exactly when assets get repriced, expectations get reset, and the foundation for the next move gets built. So the real question is not where gold is today. The real question is, what conditions are being built for tomorrow? Are we heading toward calm, stable, tighter policy? Or toward a world where the system gets stressed enough that the support comes back and the hard assets move? Because if it is the second one, then this worst week in months is not the end of the story. It might be the beginning of the next chapter. And this is where I want to hear from you. Do you think this drop is a warning that the gold rally is finished? Or do you see it as the calm before the move that long-term investors wait for? Tell me in the comments. I read every single one, and your view genuinely shapes the next videos. If you want to go deeper and stay ahead of these shifts before the headlines catch up, join the What Changes email list. The link is right below. And if this kind of research is valuable to you, you can support the channel by buying me a coffee. Every bit helps me keep digging. This is May, and this is what changes. Stay sharp, stay informed, and keep watching what changes.